Welcome back. In our last explainer, we laid the groundwork on exactly why the notes to the financial statements matter so much, and we introduced the Significant Accounting Policies Disclosure, or the SASP. Today, we're taking that knowledge and actually putting it to work. Think of this explainer as the foundational blueprint for a company's financial house. I mean, you wouldn't try to read a complex architectural diagram without understanding the legend first, right? Well, the SASP is the legend for the entire financial statement package. So here's how we're going to build out this blueprint step by step. We'll start with general and entity-level policies, then move into the specifics of assets, revenue, and liabilities, look at outside factors like currency, and wrap it all up with a crucial completeness check. Starting right at the foundation, we have our general and entity-level policies. These are the broad, sweeping declarations that anchor literally everything else in the document. Your ground rules begin right here. First up, the basis of presentation. This confirms we're actually using US GAAP, notes the fiscal year end, and clarifies whether these statements are consolidated or standalone. Next, you have your principles of consolidation. Imagine trying to combine three distinct companies without telling the reader how you eliminated the intercompany transactions between them. It would be total chaos. So you have to clearly state which entities are consolidated, including any variable interest entities, and how you handle non-controlling interests. Finally, management has to fess up to the use of estimates. They need to openly acknowledge that they rely on estimates and assumptions to prepare these financials and pinpoint the major areas where those estimates are actually happening. With that foundation firmly poured, let's start framing the main rooms, our asset and revenue policies. This is the core economic engine of the business. Revenue is the lifeblood of any company. So what's fascinating here is how the SSAP needs to seamlessly summarize the application of the ASC 606 five-step revenue model. The disclosure has to lay out the types of contracts and performance obligations involved and how variable consideration is constrained. But crucially, you have to disclose any practical expedients the company elected. If a company misses disclosing those expedients, investors are left totally in the dark about how those revenue numbers were actually calculated. Building on that revenue model, the blueprint has to sharply contrast exactly when revenue is recognized. Are we talking about recognizing it at a point in time, like scanning a physical product at a cash register? Or is it recognized over time, like a multi-year software subscription? Getting the timing wrong between point in time and over time recognition fundamentally alters the financial reality of the business. It can heavily distort profitability metrics. Of course, the engine isn't just revenue. You need strict policies for your major assets too. Take cash equivalents. They absolutely must be defined as having original maturities of 3 months or less. If a company improperly classifies a 6-month bond as cash, they are artificially inflating their short-term liquidity. For accounts receivable, you've got to outline the CCL method for credit losses under ASC 26, laying out your key inputs and historical loss rate approach. And for inventory, the reader needs to know your cost methods. Are you using FIFO, LIFO, weighted average? Plus, you need to state your policy for carrying inventory at the lower of cost or net realizable value. Now, let's look at the heavy structural beams of our financial house, long-lived asset policies. This is where we account for the massive, big-ticket items that drive value over many years. For long-lived assets, the SSAP must detail the two-step ASC 360 impairment test. Step 1, checking recoverability via undiscounted cash flows. If those fall short, you move to Step 2, measurement via fair value. The policy also has to explain exactly how triggering events are monitored quarterly. Why is this so important? Well, without strict impairment monitoring, a company's balance sheet could easily turn into a fantasy of overstated, outdated assets that don't actually generate any real economic value anymore. But here is an absolutely critical takeaway. Indefinite life intangibles and goodwill are never amortized under US GAAP for public entities, period. They must be tested for impairment at least annually, using qualitative and quantitative approaches. If you're reading an SSAP for a public company and they state they are amortizing goodwill, that is a direct US GAAP violation and an immediate, massive red flag. Now, those rules do flex just a bit depending on your entity type. Public entities can't amortize goodwill, but private companies can make an election to do so, known as the Private Company Alternative, or PCA. If they elect that, it has to be clearly stated. Beyond goodwill, you also need to outline your property, plant, and equipment policies, confirming they are carried at cost, listing out your depreciation methods, and defining your useful life ranges. This section also covers how acquired intangibles are valued at fair value, while software is capitalized at cost through a 3-stage model. Moving right along to the plumbing and wiring of the financials, liability, tax, and equity policies. These are the essential systems that keep the internal economics compliant and functioning smoothly. When you're dealing with complex liability and equity disclosures, mandatory inputs are totally non-negotiable. For leases, you have to state your policies for right-of-use assets greater than 12 months, your incremental borrowing rate, and those practical expedients. For taxes, you need the valuation allowance policy and the more likely than not threshold for uncertain tax positions. And for stock compensation, you must reveal the Black-Scholes-Merton inputs and your forfeiture policy. Literally, if you leave out something like the BSM inputs, you've created a gaping hole in your disclosure package, and analysts simply cannot verify your stock comp expense without it. Lastly, don't forget earnings per share. How are you calculating basic versus diluted, and what anti-dilutive securities did you exclude? Next, we need to evaluate the environment outside our financial house, foreign currency, and new accounting standards, because obviously no business operates in a vacuum. If a company operates internationally, the SSAP has to separate remeasurement from translation. It's a vital distinction. The policy must clearly define what hits the income statement, like transaction gains and losses, versus what gets safely captured in other comprehensive income, such as the cumulative translation adjustment for foreign ops. If you muddy the waters here, you can severely misrepresent a company's actual operating performance versus just everyday currency fluctuations. Okay, I want you to pay close attention to this next point because this is a massive trap. Teams constantly adopt a new accounting standards update, post the correct journal entries to the ledger, and then completely forget to update the SSA. Every single new standard adoption requires both the accounting entry and the disclosure update to describe the impact. Forgetting the disclosure entirely breaks the completeness of the financials. And that brings us to our final building inspection before we hand over the keys, the completeness check. This is how we ensure no required policy was left behind. Think of this as your final walkthrough. Note what's strictly mandatory, revenue recognition, income taxes, and recently adopted standards are always required. And yes, you literally have to disclose newly adopted standards even if the actual financial impact is zero. Other policies like goodwill, leases, and foreign currency are conditional, meaning they're only required if those specific items actually exist in the company's operations or on their balance sheet. But remember, the completeness checklist is just a baseline, not a ceiling. An insurance company or a massive construction firm will have their own highly complex, industry-specific rooms to add to this baseline blueprint. The SSAP has to ultimately reflect the specific economic realities of that exact business. So now you know how to build a complete SSAP blueprint, and you've seen the severe consequences of missing or incorrect policies. But it leaves us with a pretty compelling thought for our next explainer. If a single missing disclosure can completely alter someone's understanding of financial health, what filters do we use to decide exactly what makes the cut? How does the concept of materiality step in to filter these exact estimates and judgments? We're going to dive into that fascinating question in our next lesson. See you there.